Welcome to Inside India. I'm JP Ong, and here are your headlines. The Indian markets will be trying for gains after struggling in Thursday's session, with foreign buyers continuing to sell in September. India's trade minister sounding confident of resolving the country's differences with the United States, saying there's no need to panic as he prepares to host EU officials in New Delhi next week. President Trump signing an executive order formalizing the U.S. trade agreement with Japan, which will include lower auto tariffs and confirming a $550 billion investment pledge from Japan. Good Friday and welcome to the broadcast. We want to take a look at how Asian markets are setting the stage for India later on. And with judging by the morning trade, it's looking fairly positive actually for the major markets that are already open for business. We take a look at the Kospi, for instance, just holding it flat to the upside. And we're also seeing the Shanghai comps today overcoming a sluggish start. They did open in the red, but currently finding itself just a little bit in the green so far. The Hang Seng a bit more convincing, up by 0.6%. Take a look at the Nikkei 225, looking a bit more confident than others, especially after that trade deal was ratified, it seems, by U.S. President Donald Trump with Japan just the other day. And it seems that this might be just giving a little bit of a reason to smile. Also take note of the Bursa Malaysia in Kuala Lumpur, just trading flat to the downside so far in today's session. And of course, we're watching trade developments between the United States and Japan, with President Trump, as you mentioned, signing a new executive order. Lin joins us with the details. So tell us exactly what was accomplished and what was agreed upon when both of them actually met.
Yeah, indeed. So this was Ryosei Akazawa, the chief trade negotiator's 10th visit to DC, as we know, this week. And now, after the deal was announced in July, we do have implementation. And Akazawa-san, in a post on X, and we can show our viewers as well, putting the words, one word, actually very simply in Japanese, translated to say finally. And I think it's the three key points here, and these have been pressure points throughout the months, right? So certainly the headline is in relation to the auto tariffs as well as parts tariffs, down now from 27.5 to 15, with Ryosei Akazawa saying that he expects implementation within the next 14 days or so. And then also clarification now on paper that in terms of that reciprocal tariff rate, it sits at 15%, and there won't be any stacking of tariffs. That will take retroactive effect from August the 7th. And then the third point is in relation to rice as well, with that clarification in the order that in terms of the additional rice that they will be buying, it's about a 75% increase that is within the minimum access framework scheme, which has been Japan's position all along as well. But there are still questions ahead, and Ryosei Akazawa did make the note that the order did not detail any information around the fact that Japan said that they also got most favoured nation status as part of the deal. And this is really significant because ahead we know that the US president will be announcing a number of Section 232 related tariffs, particularly in Japan's context in terms of chips as well as the pharma sector. And the expectation there is that Japan will be getting the lowest rate that will be applied to other countries. We understood that to be around 15%, right, which was what was agreed with the European Union. And then in terms of that $550 billion investment fund, you had mentioned it in the headlines as well. There was confirmation of that. There was an MOU signed, but we wait for the details because Ryosei Akazawa said that the deal has not changed, right, since July. But we know that both sides have been saying pretty different things about it as well.
Yeah, it seems that all it took really to get those lower auto tariffs seems to be rice purchases. But so far, a little bit calm, at least it seems, with regards to the trade between the first and the fourth largest economies in the world. Lin, thank you so much for breaking that down for us. And keeping it with trade and tariffs, the tensions between the U.S. and India in front and center after Washington, D.C. slapped 50% levies on goods coming in from New Delhi. But Indian Trade Minister Piyush Goyal reiterating negotiations with Washington are still underway.
Well, I don't think there's any need to panic. We should allow the negotiations to happen. We continue to have very good relations with the United States, and I'm sure that we'll be able to resolve some of these issues and come to a equitable, fair and balanced agreement. No, there's never a timeline in negotiation. You should do it patiently because you are working for a long term. You have to look at the future and decide what you're.
And this comes as India tries to push trade deals with other countries and economic blocs. Goyal adding that talks with the European Union are making rapid progress, with EU Trade Chief Maros Sefcovic set to visit New Delhi next week. India and Singapore
Today,
are set to review their economic cooperation agreement on a fast-track basis to boost mutual trade. Prime Minister Modi announcing the move alongside his Singapore counterpart Lawrence Wong, who is on his first state visit to India. Wong said that the two nations will also deepen collaboration in semiconductors, from skills training to R&D, supply chains and logistics. Modi also spoke about reviewing India's free trade agreement with the ASEAN.
Today, we have prepared a detailed roadmap for the future of our partnership. Our partnership will not be limited to traditional sectors. According to changing times, sectors like advanced manufacturing, green shipping, skilling, civil nuclear, and urban water management will also become the central point of our partnership. We have decided that the bilateral comprehensive economic cooperation agreement and our free trade agreement with ASEAN will be reviewed in a time-bound manner to accelerate mutual trade.
About 39 minutes, the start of the Indian Friday session for markets there. And here's what Nifty futures are indicating for us ahead of the opening bell. We are seeing that so far Nifty futures, to wait for it to actually come online, looking a little bit more positive, actually. It seems that perhaps GIFT Nifty futures trying to indicate that there are some gains. Waiting for those numbers. There you go. Nifty futures now trading about 140 points or 150 points above the Thursday close, actually. Mind you that the Nifty 50 yesterday actually started off with gains, but then suddenly saw that turn around and perhaps wiped out also, just indicating that there are still some indications of perhaps worries or perhaps skepticism from some parts of the markets there. In fact, one of those sources of skepticism seems to be from foreign investors, which are continuing to pull money out of India's markets. Outflows have now topped $1.3 billion in the first few days of September alone. This is after they dumped about $4 billion worth of equities in August. That's the highest in about 7 months. Data shows foreign portfolio investors, or FPIs, sold nearly $2.7 billion of financial stocks just last month. Weaker bank margins and stress in retail loans are affecting the confidence in these stocks. Important to note, though, that the Nifty 50 still is holding on to marginal gains year to date despite these foreign outflows. But again, it does set for an interesting backdrop to try and assess where the Nifty 50 and Indian equities might be heading. And to do that, we're joined by Rajiv Batra, the head of Asia and co-head of Global Emerging Markets Equity Strategy at JP Morgan, to help us understand what to expect for the Nifty 50 towards the end of this year and for the year ahead. Rajiv, thank you so much for joining us. I do want to get into the report and the outlook first, but again, as we mentioned a while ago, there are these foreign outflows that have continued to persist for the Indian markets. Nevertheless, they're still up about 3% year to date and change. How big of a factor has it been in constraining the Nifty from performing as well as it has in past years?
Oh, big time, I'll say, because when we look at the emerging market this year with 21% total return dollarized, earning growth contribution to the total return is in sync what India has given, like 10%, 12%. But emerging market broadly has enjoyed 60% PE rating, 15% currency appreciation. 75% of the return has come ex growth mark over there. In case of an India, what you mentioned, 3.1% return can be totally square up by 3.5% GDP earning growth delivery on a YTD term. In fact, in terms of a PE valuation, India has got derated almost by 1%, 1.5% YTD, or if you look 1 year lens, then 11% on a YTD term. So foreign flows are not letting, or outflows are not letting re-rating to happen per se, and my domestic flows are busy absorbing the capital raising activity that is happening in India for the last 18 months.
Rajiv, how much of this is down to the tariffs, or is this down to the recent resurgence of those global bond yields that, as we know, sometimes keeps equity sentiment in check, actually? How much of this might actually be down to that recent uptick in global bond yields, again, that potentially could be sapping appetites, not just in India, but for equity markets around the world?
So recently, yes, we can say a rising global bond yield and a stagflationary risk concern started rising has been a factor. But broadly in terms, you will say it will, I will say, external factor like the evolution of relationship between India and US and the US tariff tensions overall has been the key factor that has not let India re-rate. And considering going into the event, India's risk premia was only 2.5%. And now, after 25 years of a very strong relationship, the question mark started appearing between how the trade relationship will go forward. People are challenging whether the right risk premium is 2.5 or it should be mean reverting to 4%.
Yeah, but now in the event, though, and again, something that people are watching out for is the fact that the courts in the United States have said that the tariffs might actually not be legal. If that is struck down again, could that create a re-rating scenario for India, as you mentioned, and what kind of upside might we expect if in that best case scenario, if I can paint it as such?
No, I will go along with what Scott Bessent, US Treasury Secretary, has said, that eventually India and US will get together and things will start looking normalized per se. And that is a key risk what my investors are carrying after 21% underperformance of India. They are still sticking with the sell India call, underweight India call over there, and not taking into account the normalization of relationship. The day it happens, and if it's happening also along when the growth is reviving because of the GST effort, then India could witness almost a seller strike kind of a scenario. So maybe it takes a quarter or two, but we have seen this playbook in the past with multiple other countries. As the relationships start getting normalizing, the first leg of a rally purely comes in form of a valuation re-rating.
Right. So let's talk about JP Morgan's outlook and equity strategy. And we actually spoke to some of the folks at Motilal Oswal the other day, where they said that they are seeing signs or optimistic signs that earnings in India are starting to recover. Do you share that sentiment, and how is that playing into the equity strategy that you're outlining right now for India?
So broadly, when we look at the first quarter FY26 earnings in India, and we look for the broader benchmark, NSE 500, NSE 200, yeah, the PAT growth has been in the range of around 9%, in line with my revenue growth over here. But if we narrow our lens just to the large cap, 30 names, 50 names per se, then yeah, growth continues to maintain the last 5 quarters kind of a trend. But what we have seen in this earnings season, that sectoral earnings revision breadth are improving. Yeah, obviously the dull top line index is hiding a lot of dispersion which is happening through that. As an example, in a style, like when I'm talking about the broad base 9%, but when you look at the mid cap space, earning growth is 29%. And it comes on the back of 12% earning growth last quarter. Yeah, the disappointments, I will say, was more in small cap compared to large and mid cap over there. So that was a dispersion. Similarly, at a sectoral play also, when you look at 7 out of 11 sectors in mid cap space, they have driven more than 20-25% earning growth this quarter. So yeah, the large cap, or you can say the broader index, looks bit silent over there, but within there's huge dispersions which people can benefit and generate a lot of alpha.
Why is the mid-cap space here outperforming the others, Rajiv? I mean, it's a pleasant surprise, but why is the outlook, or why has the performance been better for them as compared to some of the large caps in India recently?
So the answer goes how the policy measures are coming through. So we have seen the start of the policy easing measure have started happening with the monetary policy easing, liquidity injection, in total of 100 basis point repo rate cut, 150 basis point CRR cut in this cycle. The guys who have taken most amount the borrowing or leverages in the one, they will benefit of additional equity, rate getting lower, they will refinance. Now when we dissect them by large cap, mid cap, small cap and SME, the large cap guys have significantly delivered overall over the past 10 to 8 years as such, post the launch of IBC as such, and their debt to GDP is close to around 45-50%. Where does the high leverage sit? It's in the mid cap, small cap and MSME space. So when you are reducing the cost, making refinancing easier, they are the one who are benefiting from the lower cost of borrowing, not my large cap guys per se. And this is the reason why when the one factor of, you can say, lowering cost is clicking in, that is helping my mid cap space. Along with that, because of your tax rate coming, and now the GST tweaks have been around. So your broader market, MSME, mid cap, are turning out as a big beneficiary out of this one.
One other interesting quirk, I guess, from the recent earnings trend also is that there's some dispersion within some of the sectors, Rajiv. For instance, we saw that retail, for instance, outperformed quite well, earnings growing by in the 40s, if I'm not mistaken. But then broader consumer only growing by about 4%. Same thing with materials seeming to outperform infrastructure, which actually declined just a little bit. Help us understand why there's this interesting dispersion and why it's important to look out for that if an investor is coming into India trying to create a position in the equity market.
So I'll beg to differ on the infrastructure side, because when we look at the capex spending at YTD terms, it's up around 45% of it has been totally spent out of the budget allocated. Even when we look at the first quarter FY26, close to 25% of the entire fiscal year 26 budget has been spent overall. So government, in fact, have front-loaded their spending. But what has interestingly happened, that it is in the selected area that we have seen jump in the capex have happened. It has not been a broad-based one, which we have been used to since over the last 4 years or 5 years post-COVID as such. So hence this is the reason why that's where within the infra or industrial space also you will see so much divergence in terms of an earnings reporting per se. Coming back to comparing with materials and cement names as such, that's where even place like what capacities are available, what is the pricing discipline, what is the demand, and after how longer time it is start clicking up, that's where my cement names are beneficiary, because other things are coming into play as such. Coming back on your question on the retail and even on the staple side, yeah, retail did benefit because you went into something like a holiday season, which was in the first quarter, April and a May period over there. Some pent-up demand in the system was there that start clicking in and benefited them. On the staple side, it was more a story of top line beats. Bottom line, we still believe it will take one more quarter, and hopefully, I'll again reiterate, the third arrow which we have seen coming from India, GST cuts, will be the key driver for your staple, delivering at least a high single-digit earning growth for you for the coming second half of the fiscal year and maybe FY27 too.
And you beat me to it actually, Rajiv, because the big, one of the biggest things we've talked about over the last few days is really those GST overhauls, the simplification from 4 slabs to 2, and also the lowering of that. Again, apart from consumer-facing stocks, I mean, how broad of an impact will this have on the markets and other companies in different sectors in India?
Oh, humongous. Consumer is initial and like a no-brainer. People think as a first beneficiary over here as such, but also in consumer one need to recognize that discretionary benefit a lot compared to your staple item. As an example, if I tell you your cost of a shampoo bottle goes down by around $1.50 JP, will you go out and buy what, 3 or 4 shampoo bottles in a month? No. Whatever money you will say, let me go for my aspiration. Let me try to spend in that particular area, be it on the QSR guy, or be it on the consumer durables, or be it on like getting and paying the loan for your SUV or a better car over there. So discretionary, according to my durables, apparels, they are the key beneficiaries, white goods and even autos. And beyond that, your cement is a beneficiary, unexpected GST cut, market didn't anticipate it, 28 become 18. Insurances, where your term and life premiums are totally GST free. And if that much cost is coming lower, why don't I increase my cover much more further? Because I'm just shifting my tax now towards paying my premium over there as such. And lastly, even I will say, why not the investment and financial sector? This is what we have seen after the budget, during the budget, the income tax cut when it happened. The money has not purely gone into staples only. Money has gone into investment. Some money has gone even in deleveraging also. So like this, how this current cycle will also evolve, and it will have a broader benefit. The secondary, or you can say the indirect beneficiaries, are also your NBFCs and retail banks in the system, which market is not looking very closely over the last 10 and 15 days when we look at Nifty Bank's performance.
Rajiv, very quickly, there is one sector that you're a little wary about out in JP Morgan. That's the pharma sector. Now, I can imagine that might have something to do with potential tariff pressures, but what else is perhaps quickly Just quickly, what else might be keeping you a little bit hesitant on this particular sector in India?
Tariff pressure is one because of the US generic exposure over there. Then earnings is coming off because one of particular drug is getting off patented, which was contributing close to 13% of the revenue growth, and that will be coming to almost a 1% going into the next year. And then followed by the valuation. You are trading at plus one standard deviation mark in an environment where earning growth are declining. We have seen happening with staples. We have seen happening now with IT sector that when your growth are falling, you cannot command valuation per se. Top of it, you are coming on the back of 40% outperformance over the last 3 years and a significant both domestic and FI consensus over own sector. Taking that into account, it's a very dangerous bet to even keep a neutral, leave apart the overweight on pharma. Hence, we have downgraded that to underweight.
Wow, so good for cars, but bad medicine, it seems, for Indian markets ahead. But overall, an improving picture, at least, based on what JP Morgan has indicated. Rajiv Batra from JP Morgan, thank you so much for joining us today, helping us understand what this will mean for the equity markets in India moving ahead, especially on the back of those GST reforms. Well, we also are looking at the Thai Parliament's vote for the new Prime Minister, actually, and we are expecting that later on today. They are currently meeting at the moment. As we know, this is also the culmination of what's been a very tumultuous political situation in Thailand after former Prime Minister Thaksin Paetongtarn Shinawatra, the daughter of former Prime Minister Thaksin Shinawatra, was actually removed from office on the back of ethics violations related to her call to former Cambodian Prime Minister Hun Sen. And this has now set off a race actually to try and bring in a new prime minister to lead Southeast Asia's second largest economy. The frontrunner now apparently seems to be Anutin Charnvirakul, who is the head of the Bumjai Thai party and has now won significant support from the party with the most number of seats, the minority-backed People's Party. He does say that he has over 250 votes, which will mean that he can get to the prime ministership. We have to remember the Pheu Thai party tried to dissolve parliament or lobbied for the dissolution of parliament to try to maintain their hold on the Thai government. That was shot down by the Privy Council of the Thai royal family, and thus we are awaiting the votes for the Thai Prime Minister underway later on, and we'll be updating you on what happens with the special meeting and whether or not Thailand will have a new leader, perhaps their third one in the last since the elections of 2023. Well, more news and updates also coming up later on. Stay tuned. You are watching Inside India. A lot more to parse through. Don't go away. Welcome back to Inside India. But first, a quick check on the U.S. dollar ahead of the much-awaited non-farm payrolls data later on tonight. Again, the dollar index's direction also influencing whether or not markets in Asia do benefit because of the impact on currencies in this part of the world. We're seeing the dollar index just softening so far today at 98.12 against its major peers. Again, perhaps also lending a little bit of support for markets in this part of the world, including that of emerging markets in Southeast Asia. So far, the dollar index just seeing a little bit of softness ahead of that payrolls data, which are expected to come in later on tonight or Friday morning U.S. time. And ahead of that, we got weaker ADP and weekless jobless claims numbers. That's raising bets for the Fed to cut rates at its next meeting. Treasury yields also currently doing this on the board, and we are seeing that we're seeing bond yields just coming down a touch after that midweek uptick that we saw that really rattled and roiled markets for the better part of the last 2 days. The 10-year bond yield now slipping down to 4.1588% so far. And again, also on the back of those expected rate cuts that might be coming from the Fed, which will be the first time they actually trim rates so far this year. Meanwhile, President Trump also assembling the U.S.'s major tech leaders at the White House for a dinner. The rare assembly was a who's who of tech, with the heads of Meta, Microsoft, Google, OpenAI, AMD, and others in attendance. All the tech bosses thanked the president for his leadership, with many commitments to invest hundreds of billions of dollars in the United States in the coming years. Sticking with U.S. tech giants, Amazon has acquired Indian fintech lender Axio, giving the e-commerce giant direct access to India's lending market. The deal was cleared by the Reserve Bank of India earlier this year and will allow Amazon to offer loans at checkout and develop new credit products for consumers and small businesses. Bengaluru-based Axio will continue to operate separately, but as a wholly owned subsidiary of Amazon India. The deal amount has not been disclosed. Amid the tariff threat on India's pharma sector, the country's drug regulator is pushing to fast-track approvals and leverage AI to boost efficiency. The regulator has halved processing times for test licenses to 45 days and export certifications now clear in under a week. The Controller General says the aim is lighter regulation with stronger execution as Indian pharma looks to expand beyond the U.S., which is its biggest export market. Well, coming up, we will dig deeper into India's GST rationalization with PhD Chamber of Commerce and Industry. Stay tuned. You're watching Inside India. Welcome back. India is stepping up its race for rare earths. The government has cleared a $170 million initiative, an incentive program that is, to boost recycling of critical minerals from batteries and electronic waste. The plan runs from 2026 to 2031 under the National Critical Mineral Mission. It aims to build domestic capacity, cut reliance on China, and secure supplies for the EV makers. The government expects the push to create 270,000 tons of recycling capacity and draw 80 billion rupees in investment. We are counting down to the market open in India in just about 15 minutes. And once again, this is what futures or Nifty futures are foreshadowing when the opening bell rings. And we are seeing that the futures are showing signs of a modest gain. But keep in mind that it also foreshadowed the same before Thursday's open, before we saw the Nifty 50 actually lose a little bit of ground. So a bit touch and go at the moment, but so far they are expecting some green shoots at the open. The Indian rupee just a little firmer today at 88.09 against the greenback. The Indian markets continue to watch the impact from the overhaul of India's goods and services tax. The new structure aims to simplify and cut down taxes on hundreds of items. Network 18's group editor Rahul Joshi spoke to Indian Trade Minister Piyush Goyal about the rationalization. Here's a slice of that conversation.
Almost every product of daily use, all food products, all processed goods, foods, all material that is required for our kitchen, foodstuffs, utensils, everything will see a transformational reduction in prices. And industry has committed to us that they will make sure that the full benefit is net of input taxes is passed on to the consumers. So consumers are in for significant gain. And I'm very, very confident.
And how are you sure of that? How will you ensure that the industry
there
has
are
passed
enough tools.
There have been cases of profiteering in the past. So.
Few and far between. Otherwise, our experience is you can trust industry. Okay. Prime Minister Modi's biggest strength has been that he has trusted industry and they've never let him down. Similarly, the people of India have trusted Prime Minister Narendra Modi and we have never let them down. So I think it's a two-way trust. Industry has, across the country, every sector, assured the government that they will be with the government. They recognize lower taxes, lower prices will give buoyancy to demand, and higher demand leads to higher taxes, and ultimately higher demand also promotes more investment because the demand leads to more manufacturing in India. So it's a virtuous cycle of growth. And the multiplier impact is what will give India a big boost.
Okay. Let us also talk a little bit about the revenue implication or the revenue impact that this might have. You know, by one estimate, about 48,000 crore would be the revenue impact. Do you see that, you know, we will be able to take care of this and, you know, any kind of fiscal slip that you see, you know, going forward?
Rahulji, we are currently collecting nearly 2 lakh crores every month. And with this boost in demand, the revenue will probably go up rather than being a revenue
So
loss.
you're expecting some amount of revenue buoyancy as a result of
100%.
this? So
it is always so. And I think every theory,
right.
economic theory suggests that.
Right.
And for that matter, in 2 lakh crore a month, so 24 lakh crore, 22 lakh crore collected in a year.
Yes.
This is hardly a very consequential amount.
Well, let's turn to the first corporate responses to India's big GST cuts. Mukesh Ambani, chairman of Reliance, calling the tax overhaul a transformative step. Ambani pledging to pass on the benefits to consumers immediately. Meanwhile, apparel maker Raymond says it will cut prices on select items, with taxes on clothing below 2,500 rupees slashed to 5%. Raymond notes that 2/3 of its products actually qualify and promises that consumers will see the savings. Well, for more on the impact of the GST on India's consumption and overall economy, actually, we are joined by Hemant Jain, who's the president of the PhD Chamber of Commerce and Industry. And he's here to help us understand exactly what that impact will be specifically. Hemant Jain, thank you so much for joining us today. As you heard a while ago, it seems that the folks at Reliance and Raymond both say that they will be passing on some of these cost savings from the GST rationalization. That has to be a good thing, isn't it?
I think in today's time, when the Trump tariff had hit the economy in a very significant way, US was our biggest trading partner. So I think industry is now really looking with more inwards, looking at the consumption within India. So I think it's a great move from the government. And I think as an industry leader, I can only say the industry is here to see and benefit from the growth rather than from profiteering. So all the benefits of GST will be passed on to customers, and this will initiate a great economic growth. So we had a great quarter. Last quarter, we had the best growth rate, 7.8%. So today, I think we feel that this will again boost in the festival season, that we may see a growth rate higher than that.
You know, there were concerns raised a while ago by our colleagues at TV18 actually about the passing through, that is, of these GST rationalizations to consumers. Are you confident that this actually will happen, that consumers will actually see these instantaneously? And would this be a win-win situation both for Indian consumers and businesses alike, sir?
I think it's a much needed break. I think the Honorable Prime Minister on 15th August had said that there will be a festival bonanza. Festival time is when actually you are effectively the sales go up. So I think this is timely. In 18 days time, we will have the GST rolled out. So I think we are in for a big growth, especially in the rural sector, because we saw in last few quarters the rural demand was not really looking up. So we see agri demand coming up. We see sectors beyond urban development like infrastructure, daily uses, healthcare coming up. So we see, I think, in overall, it will be very positive, and we see that this demand will be passed on to customer, because as an industry, we are looking at getting the cycle in place, getting the buoyancy back to economy. So with this reduction in basic need items, we see specifically great demand coming in the FMCG. D2D use items, we see insurance becoming easier, health becoming easier. So I think as an industry sector, I think it's something which we are sure that industry will pass it on to consumers, and consumers will come back in bang with buying, which will give the impetus to the much needed impetus to the economy today.
Now, Mr. Jain, you did actually flag also that before we get to this, because the implementation date is September 22, we might actually see a slight dip in consumption because of consumers who might wait and see or pull back until the GST reforms kick in on September 22. How big of a risk is this after all? Or is this just really the Indian consumer inhaling before they exhale in a big way on September 22?
So I think you must be aware that GST is a state and center subject. I think that space at which this has been done is never been done before. It was announced on 15th of August. Today we are in the first week of September. It's already announced that in 18 days time the GSTs will be rolled out. So I think there will be a slip. 18 days will be people will hold on to the purchases. But I think the overall, once it is done, I think it will more than compensate the loss given in these 18 days. So I think we are looking at a great quarter four. Industry is embarking, industry is getting ready to ensure the capacities are being built up, to ensure that they are able to take over the demand coming in the festive season. So I think there will be a slight dip because people will hold on, as we can see that there's a substantial saving coming in. But I think it's something which this will be taken care in the quarter four for sure.
You mentioned the festive season, and the timing couldn't have been better for these GST rationalizations to actually kick in. Was this an effort from the government to make sure that they get the most impact or bang for their buck from the GST, timing it around the festive season? And exactly how big of an impact will this have in the coming weeks, sir?
I think today, as we go forward, today festive season has demand is almost as big as the whole year. So we are getting into the festive seasons. This is the right timing to put money in the hands of people, because this is the time when people are actually going out and buying things. So once they see that they can afford more, they can buy more. And like I said again, the rural area where the daily needs, people who are struggling because of this tariff norms, they will be coming out. This will give a boost to the economy, to the stock market. Stock market reacted very positively yesterday. So except the luxury items, which has been a slight dip, I think there will be a demand growth across the all segments.
Mr. Jain, I'm curious as to what the conversations are now between the members of the PHDCCI, actually, because as we mentioned, this seems to carry a lot of upside. Who among your members have shown the most cheer in recent days with regards to the GST rationalization in terms of possible upside to their sector and businesses?
So as we CCI vertical, items which you call today, which have seen a surge from 28 to 40%. Overall, I think all the sectors, FMCG, the travel and tourism, if I may say today, the electronics items, the farmers segment, the rural segments. So we see health insurance. I think overall we see a very, very positive effect. I think automotives, especially the luxury items, may see a dip, but I think this will be more than compensated by, because effectively Indians, 95% of Indian population will benefit from this. So this is the overall strategy taken by the government, that the common man should get it. The 95 to 99% of people who are buying this products, which are not buying luxury products, so luxury products are possibly bought by 5% of the population. So this will upsurge the demand across board. So we see a very positive side. We have about 1.5 lakh direct and indirect members in PhD CCI across 30 states. So we see a very, very positive response from the state level, from the center, from various industries. Except maybe a little bit on the automotive sector, I think everybody is really looking forward for this GST change.
So one thing also that's been flagged also is the inverted duty structure. This is something that was highlighted in the midst of all these conversations about the GST reforms. The fact that some sectors are actually seeing duties on some of their components higher than the finished goods. Actually, they've now promised to at least speed up the refunds, at least, and make more of the refunds upfront actually for businesses as part of the reforms. How momentous is this? And is this going to be something that's going to be difficult to execute? Because it seems that there's going to be a lot of money that's going to be released back to businesses, and the question of execution remains key also, isn't it, Mr. Jain?
I think I'm glad you asked these questions. People really see, and the headlines are really saying GST reduction, but I think the key to us, which is more structural reforms, GST has been the backbone to integrate the whole country into one. So when we see that today the government is looking at putting appellate authorities across states to ensure that there's speedy implementation, GST is becoming more, I would say, it's becoming more simpler to ensure that we are every common man, smaller industries also can benefit from that, because this will go a long way. I think the standardization of GST and reducing complications in GST, this is something which is going a long way into making it more and more. I think the ease of doing business, which we are seeing today in India, will increase many folds because of the reforms being done this. So I see it as a very positive step taken forward, and I'm sure we just need to ensure that whatever center policies are there, they can be implemented in the right earnestness by the states also. That's the only challenge we see. Apart from that, this is truly a great step. From 4 slabs, we have become to 2 slabs. We are right now looking at more money in the hands of people. We are looking at simplification of taxation. This will go a long way in ease of business. So I must compliment government for doing it at the right time and in the right way.
More money for the Indian consumer, but it could also mean less money for some local governments that have actually raised the issue that they might see lower tax revenues or collections from these lower GST rates, which might then also raise the concern that they might even raise some other taxes to try to offset some of those shortfalls. Is this a concern that should be taken seriously, Mr. Jain, or is there going to be another benefit from the GST rationalization that will also benefit some of these worried local governments in India?
India has planned it well. I think there is a 48,000 crore deficit which is coming because of this GST benefits we are giving. This will be partly offset by the sin and luxury items. In this, the duties have been raised. But I think the bigger story which the government is really playing in, that is a growth story. India has been, like I said earlier, there's a 7.8% growth going on in the economy in the last quarter. So we see in the festive season the economic growth rate to be getting higher. And this will more than compensate the effective reduction in GST, and the ease of doing business and actually rationalization of business will put more investments coming to India. So we see it as a very positive step. There will be more investments coming into country because GST is being simplified in a lot of ways. We see the demand growth. So this may compensate entirely whatever the losses the government have had by the year ends.
Mr. Jain, I wonder if there are now talks or conversations in the last couple of days about perhaps increasing investments, both domestic and foreign, into India because of the possible consumption upside. Have there been murmurs or positive whispers among your chamber members with regards to increased foreign investments that might come in as a second-order effect because of this rationalization?
I think there is a 48,000 crore deficit which is coming because of this GST benefits we are giving. This will be partly offset by the sin and luxury items. But I think the bigger story which the government is really playing in, that is a 7.8% growth going on in the economy in the last quarter. So we see in the festive season the economic growth rate to be getting higher. And this will more than compensate the effective reduction in GST, and the ease of doing business and actually rationalization of business will put more investments coming into country because GST is being simplified in a lot of ways. We see the demand growth. So this may compensate entirely whatever the losses the government have had by the year ends.
Mr. Jain, I wonder if there are now talks or conversations in the last couple of days about perhaps increasing investments, both domestic and foreign, into India because of the possible consumption upside. Have there been murmurs or positive whispers among
I think India is the most young, dynamic, and the fastest growing economy in the world today. So everyone across the board is looking at India. This rationalization will only increase the speed because I would say today everyone is looking at India. Apple is going to make its Apple 17 in India. So a lot of companies, semiconductors, pharma companies, infrastructure companies, Sumitomo, Japanese companies are looking at large investments into the country. So we see an overall great confidence within the economy. And this simplification which has happened, the tax, the GST reforms which has come in, the growth rate which India is giving quarter by quarter is actually acting. And we have, I think in our neighborhood area, if you really see, we are the only country which is having a stable government for last 3 quarters, to the last 15 years. And hopefully going forward, the policy making is very, very stable. The economic indicators are great. So I think everyone across board is really looking at India as a center for investment. India is a center which is not dependent only on export market, but the domestic market is actually giving the growth, giving the impetus to industry. So along with the export, I think the domestic market is key for people looking into Indian industry.
And indeed, it also seems that this is going to be a big bet, not just on the Indian economy, but the ability of the Indian consumer to transform one of the largest and fastest growing economies in the world. And we'll see if that actually transpires. But it's overall, a lot of hope, it seems, for many industries, as per Hemant Jain from the PhD Chamber of Commerce and Industry. Hemant, thank you so much for joining us today and helping us understand what it means for many of these businesses in India that might stand to benefit from the GST rationalization. Well, Indian markets have joined the trading day, and we will look at some of the movers in Mumbai after this short break. But don't go away. You can see there are some gains for the Nifty 50 so far in the opening minutes. We'll be back after 2 minutes. You're watching Inside India. Welcome back. And Indian markets have come back online about 4 minutes into the trading session, and Nifty 50 looking quite nifty so far in the opening minutes of the trade. They're up by a modest 0.33% so far in today's session at 24,816. Mind you, it was a similar picture on Thursday, but we did see some of that sentiment fade towards Thursday's close, and we'll see if they can hold on to some of these gains, unlike what we saw the other day. The rupee also looking a little bit firmer against the greenback, but again, dangerously close to those all-time weakest levels of all time at about 88.14. But overall, just a touch firmer for the local currency out in India. We also want to take a look at the Nifty auto sector, which is purported to be one of the biggest beneficiaries from the GST reforms and that were enacted earlier, that were approved, that is, earlier this week. And you can see they've continued to gain after that GST cut that was given to smaller cars. Nifty Auto now extending some of those gains. We can see they're up by about 0.7%, 26,188, with a lot of these car makers in India that are listed actually on Nifty, all seeing some gains actually and continuing this march forward and zooming forward, for lack of a better term. Now, Japan's SoftBank Group is also reducing its stake in Indian electric scooter maker Ola Electric. The group sold just over 2% of its stake in the last 2 months, bringing it to just under 16%. There were no details about the price of the sale, but the group still remains Ola Electric's second largest shareholder after founder Bhavish Agarwal. Shares of Ola Electric now down by about almost 4%. They've dropped quite a bit to about 62.03 actually so far in today's session. And moving on, extreme monsoon rains have battered the northern parts of India this year. In the country's capital, the Yamuna River burst its banks, flooding the low-lying areas. The Central Water Commission is calling it a severe situation, with flood victims reporting tough conditions and no work for weeks. At least 130 people have been killed due to floods in North India in the last month alone. Weather extremes are also impacting a 200-year-old industry in India's northeastern state of Assam. The iconic Darjeeling tea might get costlier as erratic rains, heat waves, and prolonged dry spells cut yields. Assam produces more than half of India's teas, but output has been falling year after year. Here's what people on the ground there have to say about the industry.
Last year was one of the worst years that the tea industry in Assam has suffered due to high temperatures. We had drought in the months of May. We had almost floods in the month of June and then again a drought in July. So this erratic rainfall and high temperature pattern led to a crop loss of almost 35% for us. And this was very, very abnormal. And we were 35% below our average crop and 20% below the year before, which was already a poor year.
I may sound dramatic, but last year we almost went bankrupt. If we did not have income from other sources, and including disposing our real estate, today our company would be in NCLT. It was as bad as that. And this fact is borne out by other companies also, not only by our company. So things are very grave. I see it's no point blaming climate change. Climate change is not the cause. Now we'll have to work around the climate change. Climate change is here to stay. What we can do is only mitigation.
And while Indian tea growers grapple with erratic weather, Japan's matcha is going through a different problem. Matchaholics worldwide are driving up demand and prices, but the boom is leaving some shops empty-handed. CNBC's Kaori and Joji spills the tea.
Matcha mania is turning the green powder into gold. This shop doubled the price of its top quality powder over the last year.
We sell first flash matcha, which is less bitter and has more umami. But there's only so much that's available.
But the orders keep flooding in, sometimes for as much as 1 ton at a time. Japan exported a record 36.4 billion yen worth of green tea last year, 4 times more than a decade ago. The majority is powdered tea, like matcha, bound for the U.S. Prices for tencha, the kind of tea used to make matcha, surged 170% at auction this year. Buyers fear next year's crop is wilting under a record-breaking heat wave. Before they're ground into powder, tencha leaves need to be shielded from the sun, steamed, and then dried to bring out the grassy flavor. Even Itoen, which dominates the bottled tea market globally, started a new matcha division as matcha went viral.
Our own factory and all of our contractors are jam-packed. It's pretty hard finding somewhere to grind and package the matcha.
He says farmers fear boom may turn to bust. Convincing them to switch to tencha from regular green tea has been a hard sell. Reasons for Itoen to raise the price of this tiny tin of matcha powder by 50% in September. Shops are still running out.
Very highest tea ceremony grade matcha, and also there is the very casual type, that people do not know the difference between those matchas. So they use very high quality matcha for acai bowl. So it is really, not good. So we are trying to educate
and expand at the same time. She's opening in the Philippines next month.
The Japanese government is considering subsidizing farmers to try and ramp up matcha production, but planting to harvest can take up to 5 years. Japan does have a pretty good track record, though, of turning a fad like matcha gorgonzola. It's a staple. For CNBC, I'm Kaodin Joji in Tokyo.
And before we go, just one last check of how Asian markets are doing the final trading day of the week. And so far, optimism for the most part, with intraday loss in Kuala Lumpur actually limited for the most part. Keep in mind that the Nifty 50 has opened in the green again today, up by about 0.25%. But again, we did see that there was some a test of sentiment at the end of Thursday's close when they actually lost a little bit of ground. We'll see if they have better luck today at holding on to these and making sure that it's a sweet ending to the trading week for traders out in Mumbai. And that's all the time we have today on Inside India. Keep watching CNBC. Access Middle East is up next. Happy weekend.